Up until now, we have only talked about common stocks. Now, there is a reason for that. We think that investing in common stock gives you the best shot at protecting your money and watching it grow over time. But there are plenty of other investment opportunities out there. Some are safe, some not so safe, but nevertheless, we think you should know about them. Mutual funds are a relatively safe and easy way for small investors to get into the market. Because instead of worrying about buying stocks, selling stocks on your own, you buy into a fund that is run by professionals. They do all the work. They make all the decisions. And what makes this fund mutual is that you're in it together with lots of other small investors. Your money is pooled for greater buying power. And that way the fund can buy lots of different stocks and spreads the risk among the group. Now, generally, you buy into a mutual fund for as little as $1,000, and after that, you can add on in smaller amounts. There are two questions that you could ask before you buy any mutual fund. One is, what type of stock does it buy? And the other is it a load or a no-load fund? Well, let's take this question first. To meet your investment goals, you need to know what type of stock the fund is going to buy. They don't all buy the same stocks. Some buy into conservative, steady companies for slow growth. What they're trying to give you is steady income, while others concentrate on rapid growth. These funds are looking for stocks where the price will shoot up quickly. Now, you can choose either one, but remember, these are more risky. You should also find out if a mutual fund charges a commission. What are called no-load funds don't charge, whereas load funds do. These guys charge you a load every time you invest, and usually it's between 3 and 8% of what you put in. Now, in addition to common stock, companies often issue another kind of stock. It is called preferred stock. Now, why preferred? Well, it is stock that comes with certain advantages over these common shareholders. Would you mind, please? Good. First, preferred stock comes with a guaranteed fixed dividend. You know what you're going to get when you buy the stock, no matter what the stock price, and usually no matter how the company's doing. Unless things are really horrible, you get your dividend. Even if the company doesn't pay a dividend on common stock, it will still pay a dividend to its preferred shareholders. Now, before you buy any preferred stock, you ought to find out if it is cumulative or non-cumulative. If you have cumulative stock and the company is forced for some reason to skip a dividend, those back payments will accumulate, but the company will make good at some point in the future and give you all the dividend payments it missed if your stock is cumulative. If it's non-cumulative, you're out of luck. Now, on to something completely different. So far, all we have talked about are stock investments. And as we explained much earlier, stock is equity. What you buy with some stock is a small portion of ownership in a company. But there is another kind of investment, totally different, debt. Not your debt, somebody else's debt. You lend money to a company or to a government, and they give you a piece of paper promising to pay you back with interest. And these are called bonds. Now, there are many kinds of bonds, but basically they all work the same way. You give your money to one of these corporations or Uncle Sam or whomever for a specific length of time, and through that whole period, they pay you interest. When the time is up, which is called bond maturity, they give you back the money. Now, there are two things to look for in a bond. Number one, ask yourself, is it safe? And then say, what is the interest rate? Bonds are traded constantly, just like stocks. The prices don't fluctuate as much as stocks, but they still go up and down. What affects the price the most is interest rates. Now, let me give you a little rule of thumb. If interest rates go up, bond prices drop. If interest rates drop, bond prices rise. Okay? As for safety, each new bond is issued a safety rating by Standard & Poor's and Moody's, and the safest rate for a bond is AAA. Federal government bonds are extremely safe because, think about it, Uncle Sam, to pay you back, can either raise taxes or, if necessary, print money. So you should always ask about the safety rating of a bond before buying one. And now, finally, Let us take a look at the world of exotic, specialized, and let me emphasize, dangerous investments, which are just over there. You are going to hear about options and futures and index futures. These are all for very experienced professional investors only. They are not for inexperienced, financially unsophisticated people. And with that understood, and paying clear attention to the flashing red light over my shoulder, I will now very briefly explain options. This is an extremely sophisticated guessing game. You never really own anything. What you do is you buy the right or the option to buy or sell a stock at some time in the future. But you agree upon a price today. Now, if you decide that you just can't stay away from options, at least be aware of what you're getting into, and don't go into options on your own. Get good professional advice. This is hardball, and you could get hurt. But whatever investment road you decide on, we do wish you a lot of luck.
Name two types of preferred stock. The first is cumulative, which means if a company is forced to skip a dividend, those back payments can accumulate. The second type is non-cumulative. With this kind of preferred stock, if the company misses a dividend payment, you lose. A mutual fund that charges a sales commission is called A, no load, B, discount, C, full service, D, load. The correct answer is D, a load fund. Which of the following is a bond that can't be bought? A, municipal, B, hospital, C, James, D, corporate. The correct answer is C. James Bond cannot be bought at any price.
Okay, we're just about at the end of the course. If you've made it this far, you now have a pretty good beginning knowledge of the stock market, but I bet you've also got a lot of questions. And it just so happens that some advanced copies of this tape leaked out, and the letters, somehow or other, have started pouring in, so we'd like to read you a few of those.
Dear Robert, after I buy stocks, do they mail the certificates to me? Signed, Puzzled.
Puzzled, it depends on what kind of account you have with your broker. When you open your account, you can choose to have the stock sent to your home or to your office, or you can have the brokerage firm keep it. And if you're the cautious type, have it sent to your home. Then, of course, you got to figure out where to keep it safe. And if you decide to sell suddenly, you're going to have to get that stock to your broker quickly. So it's probably more convenient to keep it with the broker.
Dear Bob, is there any way I can get a corporate report for free? Signed, Frugal.
Frugal, almost all corporate reports are free. If you own a company's stock, you get the report automatically as soon as it's published, for free. If you're a prospective buyer, you just write to the company and ask for one, and they'll send it to you, for free. The Securities Exchange Commission in Washington, D.C. makes files available to the public, and that's to you, and so will the stock exchange.
Dear Robert, what's a margin account? Signed, Marginal.
Well, a margin account is simply a credit account with your broker. It gives you the right to borrow money from your broker to buy stock. Nothing else, just stock. The margin is the percentage of the stock's price you've got to put up in cash. It's your down payment. Margin requirements are set by the government. In recent years, they've been 50%. So that means if you want to buy stock on margin, you put up half the cost and the broker lends you the other half. Now, obviously, you can buy more stock this way, but you also, remember this, you also have to pay the broker interest on the loan. So it gets expensive.